the next two papers. The papers are actually good in addition to having good titles. So let me start off with the first paper by Stakes and Mistakes, and the presenter is Abhiroop Mukherjee from Hong Kong, USD. Abhiroop, we have 20 minutes.
Thank you very much.
I think we can start now.
Thank you very much, Alauddin, and all the presenters and discussants and the audience for showing up. Let me start off by sharing my screen. So this is going to be joint work with Steffen Andersen at Copenhagen Business School and Kasper Nielsen, who is also here, thankfully. As you will see, this is a paper based on Danish data. So if I mispronounce the names in Danish, or if I get something wrong, then then Kasper will correct me. So this paper is about a very prominent but old critique of behavioral finance. If you go back to the days of when behavioral finance was sort of starting up, one prominent critique was that a lot of the evidence in the field comes from decisions involving rather small stakes. And a part of the reason is, if we typically think about small retail investors as making mistakes, and the type of people that make the mistakes are often thought to have rather limited financial wealth. And so if the losses as a result of the mistake that you make are small, then of course the benefit in correcting them may be limited by things like transaction costs. So when I say this, the thought experiment here is, if I sort of, if I go and talk to a random person on the street and I ask him, among everything in your life that you could fix, how important do you think are financial mistakes? The answer may be it is not quite top priority. And here's sort of evidence from Annette Wissing-Jorgensen's 2002 paper on the stock market participation puzzle. So the idea is the stock market, people don't participate in the stock market. Given the high equity premium, this seems to be a mistake. Now, Wissing-Jorgensen's paper kind of suggests that many households have insufficient wealth to make participation worthwhile for them. So if you look at the actual costs of the lack of participation in equity markets, for example, even a very small sort of per period participation cost of $50 is sufficient to explain why half of non-stockholders in the US don't hold stocks. So how do you do this? You essentially take the wealth that people have, and then you say, well, you know what? I'm not getting into the stock market. Had I been in the stock market, given the equity premium, I would have gotten 6% more a year. So now multiply my wealth by that 6%. It turns out to be numbers like $250, $50, $200 for a very, very substantial chunk of people that don't actually participate in the market. So now this is sort of related to this sort of going on with the same critique. Evidence from psychology, which sort of underpins much of the evidence that we rely on in behavioral finance, is often from experiments where there's little at stake for the participants. So if we examine mistakes in high-stake situations, like in some real-world financial decisions, Levitt and List, for example, have been arguing that a lot of the mistakes that you think happens in experiments might actually no longer be present in the data. So Andersen, Steffen, and John List and others have this paper in the AER where they examine ultimatum games, where it's sort of a take it or leave it offer, and people sort of feel that things are unfair, and a lot of people sort of reject the offer, although it's clearly optimal for them not to do so. They show that, well, that's true, but if you actually raise the stakes in those experiments, you can actually change the rejection rates quite substantially. This is also related to some of Daniel Kahneman's work, if you will, from the behavioral point of view. If you think about his latest book, Thinking Fast and Slow, so he sort of talks about two-system way of thinking. System one is automatic, quick, intuitive. If I show you a picture of a face and I ask you, is this face happy or angry? that's the sort of reaction that gets triggered into your mind. So you should be thinking about the word intuition when you think about system one thinking. On the other hand, there's this other system which involves substantially more effort, attention to mental activities that sort of demand it, including things like complex computation. So instead of showing you a face, if I asked you what is 17 times 362, the part of your brain, the part of your cognitive process that would be triggered is what Daniel Kahneman would call system 2. And so sort of the way this works is system 1 immediately kicks in, then system 1 gives you a quick answer. If the problem is important enough to you, you might then be able to engage system 2 and check on what system 1 is saying, and in the process tend to make less mistakes. So this is a quote from Kahneman: the best we can do in this system, the way our brains are hardwired, is a compromise. Learn to recognize situations in which mistakes are likely and try harder to avoid mistakes when the stakes are high. So he's saying the way it's supposed to work is when the stakes are really high, if the decision is really important to me, system 2 should kick in. And that's the way of avoiding sort of getting carried away by the sense of intuition that system 1 might lead us to. Now the question is, how much of this do we actually do in reality? Do we actually engage more system 2 and therefore make substantially lower mistakes when stakes are higher in real world decisions? So this is our sort of very simple research question. How sensitive are investment mistakes to how much is at stake? And so why do we care? We care because this sort of has something to say about how much of these mistakes are inherent, that sort of I cannot avoid no matter how much effort I put in, versus how much of it is just due to the fact that, yes, it's a mistake. Yes, we all make mistakes. But in the grand scheme of things, among everything that I could fix, these are not that important to me. In other words, if you sort of somehow raise the stakes exogenously for me, then I'm going to start making less mistakes. So if you want to answer this question, what might you think of as your ideal experiment? Well, that will be to randomly vary an individual's investment endowments and check whether those that got randomly higher endowments are now making less mistakes in their decisions. So how do we do this here? Well, we are going to examine shocks to investable endowments caused by inheritances due to sudden parental deaths. So I'm going to argue for the next 15 minutes why this is sort of good. What does it teach us? But also to note is that for a large number of people, this is the one context in our lives when we do actually receive a large wealth shock. You could think of people winning lotteries, people gaining other outcome, windfalls, but this is going to be a very, very small sample of people. But for a lot of us in a lot of different countries' context, this is the one time when you get a realistically large shock to your wealth in your life. So of course, this results in a larger sample, which is also helpful for things like statistical power. Now, in terms of where do we place in the literature, so experimental studies have tried to vary participant incentives. So you get the decision right, instead of $50, I give you $100, I give you a $150 type of a thing. The issue there is, of course, the magnitude of rewards. What they find is the magnitude of rewards does not seem to very significantly alter behavior. But note that even in the high reward experiment, the rewards naturally have to be limited due to budget constraints. You cannot design an experiment where the prize for getting it right is $1 million in a lab experiment. Now, another creative way in which the literature has sort of progressed around this issue is to go to environments with poorer and poorer people. So you keep the dollar amount fixed in your experiment, but you do the experiment in New York City, and then you do it in a small village in Bangladesh. Of course, the $5 is very little for the life of the average hedge fund manager in New York City, but it is a substantial chunk of income for the poor farmer in Bangladesh. Now, the only thing that we have to keep in mind with this sort of very creative setting is that experience and financial sophistication also matter when you're trying to think about financial mistakes. So in other words, the people in New York City, the hedge fund manager in New York City is not just more wealthy or has less at stake for your $5. That guy is also more likely to be financially sophisticated and experienced when it comes to what is to be done when it comes to decision making. Now, the more popular way, of course, of doing this has been sort of examining whether mistakes disappear by wealth. So you examine wealthier and wealthier individuals and you say, do they make less mistakes? And sort of this is also subject to the same sort of concern, which is that wealthy individuals also tend to have individual characteristics, for example, education, financial sophistication, etc., that correlate with the tendency to make mistakes through channels which are distinct from stakes. So the classic sort of econometric thing here is the omitted variable bias. So what do? We get data from Denmark. So those of you who know this data through Kasper's work or Steffen's work would know that this is sort of fantastic data. So it's holdings of stocks and mutual funds at the end of the year from the Danish Tax and Customs Administration. So this is every single citizen in Denmark. Whenever you trade something, you get recorded by this database. And so this is matched to the Danish cause of death registers, individual family data from the Danish civil registration system, which allows us to map people who die into who they leave behind and their estate left behind. And then we have income and wealth information from SCAT and educational records from the Danish Ministry of Education. So here's sort of financial and portfolio characteristics. So here's sort of the first vigentile. This is the bottom 5th percentile of people in Denmark by wealth. This is the top 5 percentile by wealth. So what you see here is that, not only is wealth really different, you have financial literacy or just education itself vary significantly according to the same dimension. So now the next thing we do is we sort of look at a list of different investment mistakes. And here we do not do any sort of innovation on our own. We just take measures which are easy to map into our context and are sort of thought of as important in the literature. So we look at geographical diversification, home bias. Our measure will be what percentage of your wealth is exclusively in Danish stocks versus stocks, for example, right across the border in Germany. What percentage do you actually invest in mutual funds? And what is your portfolio concentration? Do you invest in 3 stocks and you put all your wealth in these 3? Then we are going to look at investment in high fee index funds in contexts where you have a low fee index fund actually available to you. And finally, we're going to look at the disposition effect, which is the tendency to sell winners and hold on to your losers. And so this sort of list is a well-documented list of biases. No innovation here, pretty standard. So here's sort of the basic charts of the type of thing which we have already seen in the literature. This sort of by wealth, if you look at percentiles of wealth, how does home bias change, for example? And you see that the people with very little wealth have a lot of home bias, but this declines quite a bit when you look at the top 5 percentile of the population. And I can show you pretty similar graphs for almost everything. This is the fraction that holds mutual funds, the portfolio concentration of people, index fund fees, and finally the disposition effect, which seems to be rather flat. So the message is, if you sort of look at just wealth, then you see that there's this steep decline in the tendency to make popular behavioral investment mistakes according to which part of the wealth distribution you're in. Question is this happening just due to stakes, or is this something else going on in the data that a researcher that just regresses the mistake on the wealth is going to suffer from omitted variable concerns of serious magnitude? So what do? We do a difference in difference estimate first up, where our identifying assumption is that the timing of inheritance due to a sudden parental departure event is random relative to the investment decision. It's random relative to the investment environment. It's not like, if unfortunately a person lost their parent suddenly, they are more likely to do so in bad markets or something relative to macro conditions and so on and so forth. So what do? In the simplest of specifications, we sort of regress the propensity to make a mistake on inheritance, after inheritance, or the extent of wealth you inherit. You can express this as a proportion of wealth, income, etc. And then we are going to control for individual fixed effects and time fixed effects. Now, individual fixed effects are important here because the setting allows us to control for a bunch of things which are unlikely to change in your character in a short period of time around your parental death. So here's sort of the inheritances in Denmark. So what you see is, if you're in the first quintile of inherited wealth, this is the wealth to income ratio, you don't inherit much. But if you're in the highest quintile of wealth, you approximately inherit 3 times your annual income, or about 3.5 times your financial wealth when your parent passes away. And even within the fourth quintile, there's significant variation in how much wealth you actually inherit. This variation is going to be important for us for statistical power reasons. So here's a time series plot of these biases in event time. So the dotted line are people who inherit, but they inherit not much wealth. And the solid lines are people who inherit, but they inherit a lot of wealth. And 0 is the time of inheritance. So you see, before 0, you have pretty much these parallel trends going. So you see, people that don't inherit much are on average poorer. We already know that from our earlier charts that poorer people suffer from more investment mistakes than richer people. So you see the investment mistake, the levels are higher for the poor relative to the rich. That's not what I'm trying to show you in the picture. What I'm trying to show you is how these two lines diverge after the inheritance event. So it is this divergence that we are talking about, not the level of the difference. And what you see is, it is indeed does seem to be true that these two lines seem to diverge, and the guys that inherit a lot seem to make lesser mistakes than guys that don't inherit that much. And we are measuring things up to 5 years out from the parental demise event. If you want to look at it statistically, though, here's your standard regression. This is the after inheritance dummy. Now, what you see here is, this is in millions of Danish kroner. The effects are statistically significant. We have a large sample, about 511,000 people, 65,000 sudden parental death events. Still, if you look at the economic magnitude of these events, they are extremely small. So although we are able to statistically discern that stakes do seem to have an effect on mistakes, economically, the impact seems to be extremely small. Now, instead of looking at all inheritees, if I classify inheritees based on how much you actually inherited, you would see similar patterns. So you see that the guys that inherit more, this is pre-inheritance, and these are 4 quartiles of inheritance. The guys that inherit more have less biases, but if you look at this, the average home bias, for example, goes down only from 0.6 to about 0.5, even at the highest quartile of inheritance. So here's sort of a summary. If I look at one standard deviation changes in wealth due to inheritance, local bias is reduced from 62 to 59. Percentage that invest in mutual funds, 34 to 37. Portfolio concentration, 62.62 to 0.59. No effect on index fund fees, no effect on the disposition effect. So even if these effects are statistically significant, some of them, economically, these effects are extremely small. Now let me sort of criticize in the few minutes left here, what's wrong with our design? What could be wrong? First, you might argue that parents, the guys that have larger inheritances, these are not the same as the guys that don't have large inheritances. Why? Because although you're comparing within person effects, the guys that have higher inheritances have richer parents. Maybe the richer parents are associated with, I don't know what your preference is, but sort of, better resources when you grow up. So you guys are, the richer inheritees are better off and not comparable to the poorer inheritees or something. So what we can do here is, we can now keep parental wealth constant and create variation in your inheritance simply based on how many siblings you have. So these are the guys with no siblings that inherit the most. These are the guys within each quantile of parental wealth with 3 or more siblings. So your wealth gets evenly spread out, so you inherit the least. You see, even within the same parental wealth, depending on how much you inherit, the guys that inherit more, in other words, lower number of siblings, show lower biases than the guys that inherit a lot. However, again, the effects are economically rather muted. Now, it could still be problematic if you could argue that people who grow up, so let's think about it, people who grow up with different number of siblings may be different from people who grow up with no siblings, or 1 sibling versus 4 sibling is very different. Maybe they're different in risk aversion. Maybe they're different in terms of the way they've been brought up and what they've been taught about sharing resources, savings, and so on by their parents. So given the great data that these guys have in Denmark, we could actually do a bit better. What we do is, we compare beneficiaries now not only with the same level of parental wealth, but also the exact same number of siblings when they grew up. But in our treatment sample, the unfortunate people have one of their siblings die as an adult before the parent passes away. So they grew up with the same number of siblings, they have the same parental wealth, but one of the groups inherits more money, one of the groups inherits less money, simply because their sibling passed away unduly too early in their life. And again, so this sort of controls for any behavioral trait related to family size, resource sharing, etc. when you grow up, and all you're left with essentially is differences in the amount of inherited wealth. And again, you have the same thing. In the first stage in the instrumental variable, there is a strong effect, of course, on the number of siblings. If you have a deceased sibling, you inherit more wealth relative to those that don't have a deceased sibling. And in the second stage, you have similar, slightly larger, but still pretty muted effects of stakes on investment mistakes. We also examine the impact of financial advice, the fact that if you inherit a lot of money, maybe you inherit a financial advisor. Richer people have more financial advisors. So if your parent is very rich and you inherited a lot of money, maybe you inherit a Morgan Stanley investment advisor relative to the poor guy that doesn't, and maybe that's what's causing you to change your investment mistakes. We examine this, but long story short, we do not find much evidence in favor of this story. We also examine active versus passive mistakes. And the idea here is, maybe your parents' portfolio, your father is rich, my father is rich, my father is not, unfortunately, but suppose your father is very rich, you're not that rich, you inherit your father's portfolio, your stake goes up, but maybe your father was making great investment decisions. His portfolio you inherit mechanically. So mechanically, your portfolio suddenly becomes better, although you didn't do anything. Let's say you have all the Danish stocks, but your father held stocks all over the world. So when you inherit your father's portfolio, your home bias automatically goes to a much lower level. So what we do here is we kind of differentiate between the effects that comes from active decision-making mistakes versus passive mistakes. And we show that when you look at active mistakes, things are actually very similar, if not slightly worse, than even the muted effects that we showed you in the overall sample. So again, the message is stakes don't seem to moderate mistakes by that much. We look at two moderators, and I'm going to end very soon, Alauddin. I realize I'm a little bit over time. So are the effects different for the financially literate? So maybe on average, stakes don't make a mistake, stakes don't affect mistakes by much. But if you are financially literate, if you're a finance professor, maybe then the stakes really kick in. Again, we find that there is some evidence that stakes are more important for reducing mistakes when you're financially literate, means you have financial education or economics education, or you work in the financial sector, but the effects are again extremely tiny. How about more trading experience? If you have more trading experience, do stakes matter more? Yes, but not by much. So let me conclude. What we find is that stakes reduce mistakes, often in a statistically significant way. However, the reduction in the incidence of mistakes appears to be economically very muted, especially given the large baseline level of investment mistakes in the sample. Thank you very much.
Thank you, Abhiroop. The discussant is Tse-Chun from Hong Kong University.
Okay. Thanks the organizer, and thanks Alauddin for inviting me to discuss this paper. Usually ABFER is supposed to be a highlight before summer holidays, so it's a bit unfortunately we are not able to be at the Singapore Shangri-La for having fun and also enjoy research. Okay, so in the next 15 minutes, I'm going to bring the non-behavioral finance audience to a slightly bigger picture on how we're going to approach these very important topics regarding stakes and mistakes. And then it happened to be the case that when I received this paper for discussion, I watched the video by Richard Thaler. Okay, Richard Thaler mentioned in his 2018 at Chicago Rising Lecture. Well, specifically, he said that there is no evidence to support a claim that people improve as the stakes goes up. None. That's what he said during his talk. Well, the background is that just as Abhiroop mentioned earlier in his opening of the presentation, well, if you bring all the theoretical underpinnings or evidence from psychological labs to the real situations, the stakes in the lab is usually small. And then if you bring that lab outcome to the real data or the real decision making, there are economists complaining that, well, this is the word from Richard Thaler, saying that, okay, people make these mistakes in the lab, but if you raise the stakes, then everything is going to be fine. Okay, so this is like traditional economists talking. You can argue that it's John List or Stephen Levitt talking. But Richard Thaler didn't agree. He kind of say that, well, in 2018, we are still emerging from a crisis that was caused by essentially everybody making mistakes about the mortgages, right? You think about lenders, borrowers, people who were scrutinizing the loans. Okay, and then he conclude that high stakes don't make people smart. If anything, if there's any one important lesson from behavioral economics, is that people make just as many mistakes when the stake goes up, maybe even more. Okay, so that's kind of like the foundational underpinning of what Richard Thaler's have in mind. Okay, so then the outline of my discussion is that let me try to link the idea of stakes and mistakes to the behavioral finance that we have been learning from the last 20 years. And then I would talk about the idea and takeaway of the paper, and then the concept of stakes, wealth investment, and talk about mechanisms and minor comments. Okay, and then if you think about stakes and mistakes, because I'm doing retail investor study mainly, so it immediately makes me associate like the stakes and mistakes in retail investor setup. If you do Google Scholar, if you look for the items like momentum retail investor, sentiment retail investor, overconfidence, herding, gambling, weather anchoring, so you find thousands, if not like 10,000 of the articles written or the items written on the Google Scholar. So let's look at some of these examples, like, for example, disposition effect. We're starting from Odin's data or Odin's research. We know that this is real stakes. Some of them are actually very high stakes. These are retail investors trading in and out in this online, the discount brokerage account, right? And then Odin documents all kinds of the biases, including disposition effect. We also have behavioral corporate finance literature on overconfident CEOs. Overconfident CEOs can make huge high-stakes mistakes like overpaying their target. Or you have paper talking about, it could be overconfident bank CEOs who lowered the lending standard and then also took too much leverage and resulting in huge losses during the 2008 financial crisis. Okay, or if you look at Kumar's paper or my paper with Xiaohui on how gambling desire, that's in a sense you can also call it mistakes or investment mistakes for sure, that how much money they can lose, right? Then if you look at more recent data, not just relying on Odin's brokerage account data, if you look at data using either internet login or fintech apps, papers written by Alberto and Francesco, you will see that whether they invest attention, whether the cultural bias, discrimination, whether the present bias, or whether the low participation in risky assets would be induced or exhibited by all these kind of behavior mistakes that we have in mind. Okay, and then if you want to have some causal evidence using shocks, we have weather, we have soccer outcome, that's a mood shock. We have divorce as tension shock to the fund managers, that's by Melvin's paper. We also have natural disaster, terrorist attacks, air pollution, extreme temperature, that's Darwin's paper, housing market, and neighborhood winning the lottery tickets, that's Sumit's paper. Right, so we have all kinds of the shocks from all different dimensions, try to understand whether these shocks affecting some kind of behavioral bias and then how that ends up in the high-stake games. Investing, housing decision, fund manager decision, these are all high-stakes games. Okay, and there are also papers documenting to what extent the high stake we are talking about. If you look at, again, Barber, Lidio, and Odin, using Taiwan data, they are saying that this potentially overconfident Taiwan investor, they're actually losing 2.8% of their total personal income, which can sum up to 2.2% of Taiwan's gross GDP. And that's not low stakes games, right? That's how much you can lose as an overconfident, or at least when you trade too much in the stock market. And there's also data from mainland China talking about, well, if you look into the losses during the bubble and burst, it could be 30% of either group's initial equity wealth. And that's a lot of money, like 250 billion RMB we are talking about. So these are not very low stakes games. Okay, so that's kind of my reflection when I read this paper and how it is associated with like the behavioral finance, or at least the retail investor study or household finance study that we already know. So that's kind of like a big picture that I would like the authors to think about it. Like, how are you going to link the two, or building on the existing retail investor study and then try to move forward of the knowledge frontier. Okay, so come back to the paper. Well, the idea is relatively simple, using sudden deaths of the parents as shocks to study like 5 behavioral finances, like diversifications, suboptimal asset choice, investing in high mutual fund high fee funds, or mistakes in trading. Okay, the finding is that unexpected inheritance will reduce investment mistakes. Well, it's typically statistically significant, but economically very small. Okay. So what I like about the paper is that it's a very clean shop to individuals' wealth. It's not easy. This is the key selling point. If you want to have, well, unless you really planned a game that you send a helicopter and then really throw the money, and you will be able to do this at a one control group and in one treated group, but that's not going to happen. Okay, so, and it also provides not only like they provide this very nice Wells shock, they actually move one step further to do this variation in the number of siblings. So that's for one. And the second one is variation of number of siblings only before the parental deaths. So that is able to control for like sibling effect. If you grew up with a brother or sister, or that might make you a very different person. So that's kind of like the empirical design that I like. It's in a sense a very nice sequel of Andersen and Nielsen 2011, using the similar data, but actually using the same data, using the same Wells shock to study the participation constraint. Basically, Andersen and Nielsen 2011 finds that Wells has a positive effect on the stock market participation. That's not so much about the participation cost that prohibits some people to participate into the risk-sharing stock market. Okay, so the contribution is also very straightforward. They are trying to argue, I mean, the author is trying to argue that the existing literature by Wiesen-Jorgensen and the others, they usually provide the correlational evidence between the wealth and investment bias. Now, with this nice shock to the wealth, they would be able to provide the more causal evidence. Okay, so that's the key contribution of the paper, relying on this nice data and setup to identify the causal inference of the wealth shocks to the investment mistakes. Okay, so here are some of my quibbles. First of all, are stakes and wealth equivalent? If you really think about it, the identification of the paper is actually the wealth shock. Okay, so if you look at the lab participants, they can be actually personally wealthy, but they are participating in low stakes games, right? Like $5, $10. And some of the stock market participants, they are actually not wealthy at all, but they are participating into high stakes games. If you think about like YOLO investor, GameStop episode, they are not rich, but they are willing to put all their wealth into this game. And that's very high stakes game. We are not talking about like $5, $10. I mean, you could even go with the leverage. Okay, so the identification relies on wealth shock, but it's not really on stakes per se, especially not stakes in the risky assets per se. Okay, so that is part of, I guess, the reason why the economic magnitude is kind of like small. If you look at it, the paper finds that the 1 million Denmark is 134,000 euros. It's going to reduce if you inherit the wealth from the parents of that amount. It's going to reduce the tendency to invest in local stocks by only 0.7%. It's because not all the money you inherited you put into stock market investment. Okay, so that's potentially explains a little bit part of it, because this is not like you are inheriting this amount of the wealth and there is a law saying that you have put all this money into stock market. And then let's look at to what extent your local bias is reduced by that exogenous shock. It's not like that. It's like you get the money, you get the inheritance, but no one is forcing you to put the money into the stock market. Okay, so that's not, to me, it's not really the stakes shock. It's more like the wealth shock. And then the wealth shock will be a noisy proxy for the stakes shock, if that stakes is all this paper is about. Okay. And the problem is that the difference between how much money you inherited from the parental wealth and versus how much money like you are willing to put into the stock market, it can be related to the mistakes that you are making as well, right? If you think about it, if you look at Andersen and Nielsen 2011 RFS, they find that the majority of households, after the inheritance, they actually actively sell the portfolio. So some people, even they enjoy this wealth shock, but they actually do not want to have the money in the stock market. They reduce it, they sell it. So this wealth shock does not really represent the stake shock, and this not a stakes in the risky assets, because evidence shows that they are selling the portfolio. And the reason why they are selling the portfolio could be related to the unobserved characteristic, for example, like IQs, financial sophistications, et cetera, et cetera. Okay. And then if we are talking about wealth shocks, there are two papers that are pretty related. One is Veronica's paper, Brock et al. And Poor et al. They find that, well, they use the collapse of housing market as exogenous shock to the fund managers. And they find that, well, if you have negative wealth shock, you are also going to reduce your risk taking. Another paper, also from the Nordic country, from Sweden, I think, using the lottery windfall gains to increase the market participation. So this paper is similar to Andersen and Nielsen 2011. The difference is that they rely on the lottery windfall instead of the sudden deaths of the parents as the identification strategy to study the effect of stock market participation due to the financial constraint. Okay.
DC, you're running out of time a bit, so.
I'm already running out of time. Okay. So then let me just talk about the most important one since Johan is here. If you think about using the parental deaths as exogenous shock, then parental deaths not only bringing you the wealth, it also brings you the sorrow, the emotional shock. Then Johan has this paper like using the parental deaths of the fund manager, and they find that they actually reduce the risk taking. It can also only be found in the corporate manager. So to me, the identification of parental deaths is good, but the problem is that it's also a shock to the emotion, and that emotion is going to cause very different risk-taking behavior. So I would encourage the authors to at least talk about it. Okay, so to conclude, this is a very important question. It's a very clever design, and I would encourage also to rethink how is these stakes and mistakes or wealth shocks, how they're related to the retail investor study that we know, and I would recommend it to everyone. In the end, Richard Taylor is right. Okay. Okay, thanks.
Thank you, TC. Abhiroop, you want to respond quickly?
Okay. Thank you very much, TC. Thanks a lot for reading the paper and your comments. Yeah, so I'm not going to say much except you point out why we should write this better, and that's all very well taken. Essentially, we are not trying to claim that there is no evidence that people don't make mistakes in high-stake decisions. It is just that in a lot of models and so on, what we are really interested in is the delta. If I change stakes, then how much? What is the sensitivity? And to the best of our knowledge, there is no evidence on what is the sensitivity of stakes to real investor mistakes. I can show you that wealthy people make less mistakes and so on, but that doesn't mean that by exogenously shocking wealth, keeping everything else constant, I can show you the same thing. So that's essentially, we have to do a better job clearly of explaining this and writing better. But I don't want to spend too much time. Thanks a lot for the discussion.
Abhiroop, you talk about looking at siblings and how that affects the behavioral bias. Is there, I think you have the data to look at whether they inherit the behavioral bias from the parents, right? So you look at the portfolio or behavioral mistakes that the parents make in their investment, and is that what get passed on to the kids? And does that explain some of the biases?
Right. So there's two parts, right? So one is physically, I inherit your portfolio. So whatever bias you made, because I inherited your portfolio, I'm going to inherit that bias. And clearly a lot of that happens. The second is you have a particular way of thinking, which results in, not you, but someone's parent being biased. And do I inherit that particular way of thinking? That we have not quite checked in the data.
There's a question from, I think it's Darwin, right? I had a question from Darwin. No?
Yeah.
Yeah.
So I know there are a lot of measures of people's mistakes. So I wonder, why don't you look at returns?
We will do that. We just haven't gotten around to it yet. We will look at performance. Yes.
Okay, yeah, because to me, under diversification may not be a bad thing. Like disposition effect may not be a bad thing. A home bias like these. I mean, if you look at returns, are exposed, are realized returns.
Yeah, right. So, that's sort of, we will definitely do that. We are still waiting for an update on the data before we start doing some of this. In terms of, if I don't like speculating, but if you ask me, if I look at the previous papers on this, they have kind of shown some of this, that in Denmark, under diversification on average is a big mistake. Given what you're right, that theoretically I can't link it. It may be good, but it turns out not to be in the data, in this data set.
Yeah, I have another quick question I didn't type in the chat. So how much of that? So I know you look at something about financing, like from the parents. Sorry, not financing, advising, financial advising the parents have. But what about me? When my parent died, I know I have a big chunk of money. I don't know what to do. I go to the bank now and ask for some advice. So how much of your results are due to that?
So that's what we look at. Sorry, I might have misspoken. We don't look at we don't know if your parent had a financial advisor. Essentially, what we do is we exploit this variation in the data that a lot of financial advice in Denmark comes from big banks. So let's say, it's sort of like, it's not the same, but suppose I have an account with Interactive Brokers. I'm not going to get financial advice from them, or Charles Schwab. Versus if I have an account with Morgan Stanley or Goldman Sachs, I'm more likely to get advice. So that's the type of thing we do.
Okay, good. Thank you.
So that's one last question. I think I'll let Abhiroop respond to it. There's two more questions. One is about the definition of stake. If there's a change in the wealth, does that mean a change in the stake? It's kind of related to what TC, brought up about the difference between stake and wealth, right? Johan has one question, maybe just clarification. Okay, so I'm going to stop here and move on to the next paper.